you think gold's going to keep going up then? You think this is actually a great time to buy?
I think it's a discount price. It's very difficult to always assume I know what the real price, the true market price is of gold, but I do understand the fundamentals of gold, and it's still there. So what I like to do is explain why I like gold as an asset class, and then show you where the fundamentals are. And I brought in charts if Dallas could show that. When I talk about gold, I talk about it as money. And that sounds crazy because we don't generally think of gold as money. I don't think of it as an investment. It doesn't pay you dividends. It doesn't grow in nature of, of a balance sheet. You know, 1 year you own this X amount of widgets and the next year you own X plus 2 amount of widgets. It's gold. What it is, it's money. It's a commodity. It can be used in exchange and it possesses value. That's the definition of money. So in the next slide, let's take a look at money, gold, versus what we use in the United States economy, U.S. dollars. Gold is valued because of its beauty and its use in jewelry. Now, when you proposed to Leona, I'm guessing she would have slapped you in the face if you put a ring on her finger that didn't have a little gold on it, right? Even if it was white gold. And that's generally what has happened for thousands of years. If we go into an old pyramid in Egypt, you'll probably find gold somewhere in that buried treasure. If you go down to the depths of the sea where a ship is, a Spanish ship, you probably find gold on there. So it's been valued for thousands of years. Unlike U.S. dollars, if you just take a pure physical paper dollar, it has no value other than what you can use to burn, right? So fuel. So dollars essentially have no value except for what law does, and law comes in and says this can be used in all debts, public and private, and we call this legal tender law. So that's where the value of our U.S. dollar comes from. The other thing that's interesting is knowing that money is a commodity, gold's supply is relatively stable. You have to dig it out of the earth or you have to dig it out of the sea. Either way, its supply is relatively stable as opposed to other commodities like corn. You could have one bad growing season and all of a sudden corn is scarce and the price goes up. Oil, you could have a oil rig go down and all of a sudden the oil supply is scarce. Or you have a couple more oil rigs go up, something like what's happening in North Dakota, and the supply has gone up and then therefore the price has gone down. The U.S. dollar is a little different here. Supply is increased or decreased, actually digitally nowadays, but even if it was in the sense that you have to go through a printing press with paper, there's so many trees that there's really not a scarce, it's not really a scarce resource. So it's easily increased its supply. So that's the other important difference between gold as money and U.S. dollars as money. So now knowing that, if we go to this next slide here, we see that a dollar or a currency that's not backed by a physical metal or a physical commodity is called fiat money. And that's not just the U.S. dollar, it's also the euro, it's the yen, and the pound. So it's very important here. When we look at what the central banks that issue each one of these currencies has done in the last decade or so, we can start to understand why prices in the economy, especially in gold and other commodities, have gone up. So if you go to this next chart, I'm going to show you, courtesy of Double Line Capital and Bloomberg, I'm showing you right here the balance sheets of the major banks. On top here is the Euro, the ECB, the European Central Bank. It's in green. And that's had an incredible increase in the last decade. And right below that in purple is our own Federal Reserve, which issues our currency. And you can see a huge spike following the mortgage crisis. And then also the other major banks here following suit. Japanese, you even see a spike post the earthquake and tsunami event.
So this, can you explain this graph a little more?
Sure.
Then this is basically the number of dollars or euros or yen or pounds that are out there in circulation, in securities, in mortgages, or
not quite, but it would look fairly similar. What I'm showing here on this chart is the balance sheet. Okay, of the central banks. So you'll see in the purple is the Federal Reserve, and it's shown a balance sheet of $3 trillion. That means the assets they have. Now, the Fed didn't all of a sudden come across, if you look here since January 2008, where they were under $1 trillion, it's not like they came across $2 trillion in new assets. What they did is they create new credit or new money, and then they buy assets with that. So in fact, what these banks are doing is they're creating inflation. A more accurate measure of what you're talking about is the monetary base. So if we go to this next slide, I actually show that, which you'll see it's a similar trend. And here in particular in the United States, when I compare the price of gold since 1986 to the monetary base, which is all the money in circulation in the U.S. economy, you can see that as an increase or decrease percentage per year, that gold has actually underperformed the monetary base. I guess I shouldn't say underperform, is it's not a price that we're talking about, but the price increase does not quite keep pace with increase in the supply of money in the economy. And that's a further explanation of how inflation works. But generally speaking, as you can see, and this is my argument here, as the monetary base increases, so the amount of money in circulation increases, so does the price of gold. And in particular, why people talk about gold's on a bull run or it's a bubble even state, because they look at this chart here and they see in those last couple of years, the last 6 years, gold has increased an incredible amount, but what has also increased during that point is our monetary base, our amount of money in our economy. And so I actually think that the more money there is in an economy, the less value each currency unit, therefore the price of gold and other commodities will continue to increase. So until I see a reverse of monetary policy, I will remain bullish on diversifying into the gold.
I need some further explanation, because when I'm looking at these two graphs that are here, the gold price versus monetary expansion, and then the amount of the balance sheets in the previous one.
Sure.
If you look at both, what I find alarming is you see in the purple line, that's the Federal Reserve balance sheet, and from 1995 to 2008, that's a fairly steady and responsible curve.
Yeah, a fairly conservative bank is what they call it.
There's not much change. It is slightly going up, probably hitting that target inflation rate, but then you hit the 2008 and it spikes up dramatically, and you look at the gold price, it's the same thing. What is driving that?
It's a shift in philosophy. Well, even that might not be the correct way to put it. I think the philosophy's been there. It's called Keynesianism, where a government or a central bank needs to step in and stimulate an economy during a bust cycle. What I think it is a difference in activity, where our central bank has completely lost any conservative, steady increase in the monetary supply and used the bank's printing press in order to try to save the economy, to stimulate it, partly because the federal government's incapable of doing it with their large budget deficits. In fact, a lot of what this money is buying is our federal debt. It's buying U.S. treasuries.